Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show aims to get you actionable insight so that you can make your investments into mutual funds with confidence. Now, we've discussed a wide array of topics on this particular program, and that has included categories of mutual fund schemes and new mutual fund schemes that are on offer. The latest one that I'd like to talk to you about is in the multi-cap category, which, as you know, is a carve-out that was made by the Securities and Exchange Board of India, the market regulator, when it felt that the original multi-cap category of actively managed equity mutual funds was not true to label. So it stipulated that multi-cap mutual funds would have to have at least 25% of assets under management each in large cap, mid cap, and small cap, and the remaining 25% would be allocated based on the fund manager's judgment. The fund houses at that moment were allowed to move out of the category and have their funds called Flexi caps instead, which don't have any such restrictions, and a lot of them chose to do that. But of late, you've seen more fund houses move into the multi-cap category as well. One of those is Motilal Oswal Asset Management, whose flagship fund, by the way, is the Flexi Cap fund. They are now launching a multi-cap fund, and to find out what it's about, why they are launching it, I'm joined by Ajay Khandelwal, the fund manager at Motilal Oswal Asset Management. Thanks so much, Ajay, for taking the time, and hopefully I've provided enough context for this conversation. But let's start with why Motilal Oswal is now planning to launch a multi-cap fund when it was one of the funds that chose to move into the flexi cap category rather than continue with multi-cap.
Hi, thanks, and good afternoon to all the viewers. For Motilal Flexi Cap, when this whole change happened, the category itself is more levered towards large cap. And in our flexi cap also, we have around 40% mid and small cap, but mid cap is largely predominantly almost 35% of it. So this category flexi cap is catering to a risk profile of investors where they want little less risk. For the industry also, if you look at the flexi cap schemes are almost 70% plus large cap. And for us, it is around 55% large cap and rest is small and mid. When coming to multi-cap, I think as you spoke, the category will have 25% coming from all three categories. So this will be a better balanced category. And over a period, we have seen how this category has actually outperformed a diversified index like Nifty 500 on a rolling basis on 5 years, almost 100 basis point kind of alpha delivered by this category. So I think this, from our side, we want to bring a good scheme where we'll have best in-house ideas in all three categories. And this is perfect for risk appetite of investors who want to have little higher risk than a large cap or a flexi cap.
That's interesting. I was actually looking at some data points, and I've only looked at, Ajay, the last 1 year and 3 years, because after 2020, I can't remember the exact date. I was actually trying to pull that up. It feels like a long time back. You will probably remember when that split happened between flexi-cap and multi-cap, but it's not been a long time. So what I was seeing is that in the multi-cap category, 63.2% of multi-cap funds have actually managed to beat the benchmark over the last 1 year, and 55.6% have managed over a 3-year period. The number is lesser in the flexi-cap category, 44.1 in the 1 year period and 33.3 in the 3-year period. Is that a factor of how the broader markets have moved over the last 1.5 years? And therefore, would you say that it's not necessarily an accurate representation of what these funds try to do?
So, Alex, as you spoke about when this categorization happened, most of the large AUM schemes, they move towards flexi. So as I said, the industry has more than 70% in large cap only, whereas ideally a flexi cap will have more nimbleness based on market cycles. And last 1 2 years, if you look at also the earning differential for small and mid cap has been fairly higher than large cap, and the same is reflected in price performance also. So multi-cap, because of the construct, has higher mid and small cap exposure, and these categories have outperformed, and which is same is reflected in the scheme's performance also. Uh, so I would say we have to look at from the investor's risk perspective, because see, there will be volatility in earnings for small and mid cap. So anybody who has higher risk appetite is more suited to have multi-cap category.
It's a fair point. I'm just curious about how you will run the fund as well. Because you've mentioned about the kind of ownership of assets in the flexi cap category. How will this multi-cap be different in terms of how you will manage it? Obviously, there are tight regulations in terms of how much of the assets have to be in each of the categories. So relatively less wiggle room, if you can call it that.
Yes. So, see, interestingly, Moti, we have a different philosophy. We focus on quality and growth. So, I think UGLP is well known. But the other difference that I would like to highlight here is that all of our schemes, we are well diversified, but at the same time, we are not overly diversified. So, all our schemes, you will find we have 30 to 35 stocks. Even in multi-cap, where the peers have average 80 stocks, we plan to run a 35 stock portfolio. And allocation also, we want to control the risk. So in terms of allocation, the stocks will be between 2 to 6%. So we want to have right diversification. And at the same time, we do not want to have over concentration.
Okay,
so that is something.
Okay, but explain this 30 to 35 stock portfolio allocation. Is that also going to be a factor of how much you will have initially in the form of assets? Because I know that a lot of schemes, particularly in the broader end of the spectrum, have had to expand their portfolio size very dramatically because of the kind of AUMs that they have received. So is that also a factor of nimbleness when you are starting out, when you have lesser assets?
So, Alex, again, here we are focused in terms of risk management. So we look at liquidity risk also in a very important way. And within our fund house, we do not look at stocks which are below 2,000 crore market cap. And even in any of our schemes, you will see average based on the mandate of the scheme, the average AUM is little on the higher side. So we are trying to build more scalable portfolios. And whenever there's change in business fundamentals, ideally we should be able to, do a course correction if that is required. So here also we will have basically we will have more inclination towards higher large cap stocks. So just to give an example, if there are two stocks in different categories, say large and mid, and if we see similar kind of upside where based on intrinsic value, we believe that there's similar upside, we would prefer a large cap. But then there are certain sectors where the leadership and that sector representation is better there in mid and small cap. So we'll be having right stocks picking from there. But I think because see, this category anyways has 25% large cap. So even if you go to around 40-45%, rest 50-60% would be in mid and small. So I don't see that liquidity risk, and at this point in time, I don't believe that we require long tail portfolio. When we are running our mid cap scheme, which is north of 10,000 crore, we are still doing it within 30 stocks. So I think we have amply demonstrated this, that without taking any liquidity risk, without having any over diversification, we are still able to manage and perform.
I have a couple of follow-ups to the portfolio management strategy, Ajay, just to understand. What will be the objective, or what will be the framework that you set up, or the approach that you have with regard to keeping cash and dry powder available? Because I would think that a fund that invests strategically also into small and mid caps should be able to tactically deploy whenever the opportunity presents itself. So how will you manage the cash? And I'll come to the second question once you answer this.
So See, we believe that, I think most of the guys say it, but we genuinely believe time in market is more important than timing the market. And especially when equity investors have given money to mutual funds as part of their equity allocation, we believe that it is prudent on our part to stay invested. So we try to avoid timing the market. But as I said, for small caps, because see, again, we are entering into result season in now another month and our NFO is closing. So we'll be deploying money in a prudent way. We have our model portfolio ready. And so based on our model portfolio, we'll be making our allocations. And I think in a month's time, you will see that we have our most of the money deployed, because we do not want to run that kind of risk where, again, market goes up and we are sitting on cash.
Okay. Okay. So and you're talking about the proceeds that you receive from the NFO. Within a month, you will have deployed everything, right?
Even before that. So I'm saying that's at the outer limit. But yeah, we will be deploying our cash in a more prudent way based on the opportunities available.
Okay. I'm also trying to understand broadly the allocation towards mid cap and small cap at any given point of time. Are you saying that you can utilize the maximum, or will you likely not go to that extent and it will broadly be between a 50 to 60% kind of a range?
Correct. So see, based on our model portfolio, this is where we believe that we will have 50 to 60% range in mid and small cap, and large cap would be around 40 to 45%.
Understood. Now, are you sector agnostic completely? And would I be right in understanding that something like this, once it gets large enough, Ajay, you will have inputs from individuals that manage individually the small cap, mid cap and large cap funds at MOSL?
So I'll take the second part first. So see, the good part about this scheme is that Niket, who is managing our mid cap and flexi cap, and I will be co-managing. I look at the small cap and the large and mid cap fund here. So both the fund managers have strength in certain domain, and we will be co-managing it. So that is the first part. And sorry, what is the other question that you asked?
To be very frank, I completely forgot what the second part of the question was. So I don't blame you for forgetting as well. But oh yeah, I was asking about sectoral allocation, Ajay. Are you going to be sector agnostic, and what is the kind of philosophy that you will follow in the selection of these 30 to 35 stocks?
So see, what at MOSL, MOAMC, what we have done is that we clearly have focused on certain pockets of market where we see better growth. And across our schemes, if you look at all our schemes, will have 2/3 of our portfolios in the themes and sectors where we believe as a house that earning is better than broader market. So we have sharper focus on sectors. At the same time, we are, as a risk strategy, we do not deviate too much from sector weights. So for example, if we do not like certain part of financials, we will have so many subsectors within that where we'll be picking stocks from subsectors. But by and large, you will see that we are not deviating too much from sectors. So our risk is always contained.
Okay, that's a fair point. Thanks so much for joining us, Ajay, and giving us a perspective on how you're going to be managing this, and interesting insights coming through. I look forward to speaking to you once the fund has enough time to run so that we can touch base and identify how things are going. But thanks as always for taking the time.
Thanks a lot. Thank you.
And I'm joined by Amol Joshi, founder of PlanRupee Investment Services. Thanks so much, Amol, as always, for taking the time. I don't know if you heard any of that conversation, but let's talk about the category as a whole. And what I was pointing out, the data that we pulled up suggests that multi-cap as a category has done better than flexi cap, or rather has beaten the benchmark. More of their funds have beaten the benchmark than flexi cap in the last 1 year and 3 years. Do you think that that's because the broader markets have done so incredibly well? And is that enough of a benchmark for you to take to decide to invest in these schemes?
Well, Alex, good afternoon. Thanks for having me over on the show. I was able to catch some part of the conversation last few minutes, and thanks for arranging that for all of us. To answer the questions, you see, you're right. Over last 1 year as well as 3 years, multi-caps have done better than flexi caps, and they have been able to beat the benchmarks. Both the observations are correct. To really understand what's going on behind the curtains, we should first kind of identify what flexi-cap funds are and what multi-cap funds are. Flexi-cap, as the name suggests, these type of funds can invest across the market cap, be it large cap, mid cap, or small cap, without any upper or lower cap. So just for an example, fund manager can decide to go overboard depending on their internal research and their conviction levels. They can probably, fund manager can decide to have, let's say, 60% into large cap and only remaining 30 to 40% into a combination of mid and small caps. However, that's about flexi cap funds. However, what multi-cap funds are and how regulator has defined the category is you should have a minimum of 25% each into large cap, mid cap, and small cap. So no matter what fund manager's outlook is, no matter what the valuations are telling us in different segments or market capitalization segments for the portfolio that we build, but suffice to say that at all points in time, you will have minimum 25% each into mid and small caps. So at least 50% portfolio goes into mid and small caps. That helps, or rather that has helped. We have seen over last year, especially from last March to this March, mid and small caps have delivered anywhere between 60 to 80% kind of returns, and large caps haven't done all that well. Large caps have probably delivered 30 to 40% return depending on what basket you look at. So yes, that's the reason behind the mid and small cap allocation has really helped multi-cap funds score over their peer group in flexi cap arena, and the reasons are having the mid and small cap allocation.
So we've seen an unprecedented run up or bull run in the equity markets, and the broader markets have done incredibly well, Amol, and you've just made that point. But would it be fair to say that a multi-cap fund offers less downside protection than a flexi-cap fund? And so therefore, from that perspective, one must be wary of investing in these, or at least aware of the risks?
Right. I think I would go with the second point that you mentioned. One should definitely be aware of the risks. So many a times, and no matter how far along we are in the journey of investments over last several decades and new investors joining in, many of the times it is seen that especially newer set of investors take for granted that past will probably replicate itself similarly into the future. That's why there is a disclaimer in every mutual fund advertisement that past returns are not guarantee of a future performance. So let past and let data guide us. So let me take you back a little bit to 2018. As we know, market made its all-time high sort of somewhere around in early part of calendar 2020. But mid and small caps were down from 2018 all the way till COVID crash. And this segment probably lost anywhere between 60 to 80%, again, depending on what stock basket or what kind of sectors you're looking at. But mid caps and small caps were in kind of secular bear market over that 2 year period. Against that, compare it against that to Nifty. What happened to Nifty? It made its all-time high in the early part of 2020. It has saw a flash crash during Corona of about 35, and then the recovery we all have seen. But suffice to say that you should be prepared for longer periods of underperformance. See, you cannot invest into mid and small caps and compare the portfolio or scheme return with a benchmark index like Nifty or Sensex. So keep that in mind. Mid and small caps can see deeper drawdowns, number one, and they can remain beaten down for longer period of time than large caps. So let that certainly be at the back of your mind. But somebody who calls himself an aggressive investor and has several years of investment horizon and wants to take exposure to all segments of market without having to have, let's say, 6 or 8 or 12 funds, I think a combination of a flexi cap as well as multi-cap, which gives him a segment as well as the fund manager's expertise via flexi cap funds. I think this combination is good to have if you really have a long-term investment horizon.
Amol, of course, we'll have to wait and see what the portfolio of this particular scheme, the Motilal Oswal scheme, looks like. But based on what Ajay was just pointing out, the fund manager, he was saying that the aim will be to have between 30 and 35 stocks, which is not that many if you think about it, especially if we're looking at broader market mutual fund schemes that actively managed have a very large number of stocks currently. So is that something to bear in mind also when you select a multi-cap scheme, and how much of an allocation would you say is appropriate to have if you have the risk appetite to have such a scheme?
Well, there are two different schools of thoughts, Alex, as you know very well. If you spread yourself out too thin in terms of having, let's say, 50 or 70 or 90 stocks, your per stock weightage will be kind of less. And even if you find potential winners, you as in fund manager, it's not going to add too much to the tally because your exposure per stock on an average will be 1% if you have 100 stocks. Obviously, I'm talking about averages here. Come to the other side, if you have only 25 to 30 stocks, you can have a meaningful exposure of 3 to 4% per stock. But the other side, it is a knife that cuts both ways. The other side is if you get some of your bets wrong in such a concentrated portfolio, then it will probably have a greater negative impact than when a stock has only 1%, 0.5%, 1.5% kind of exposure. So it really depends on what kind of conviction, what kind of fund management philosophy that a fund manager follows. But however, let's give them a benefit of doubt because as you know, Alex, this is an NFO new fund offer. So they would not have the size issue or AUM issue to start with. So even if, few thousand crore rupees, if any NFO generates and if they want to participate, I mean to say the portfolio is constructed only via 30, 35 stocks, I think the exposure would be in such a ballpark that it is very well manageable. It might, of course, change. And I think I previous answer, I mentioned let past guide us. So Motilal Oswal, their previous funds were all following similar philosophy. If we go back 7 or 8 years in the past, I think their mid-cap fund, which is currently only Motilal Oswal mid-cap, started as Motilal Oswal mid-cap 30 fund. So as the size grows, or if they find any kind of, this is just the beginning, but if there were any limitations, I think the fund manager and the AMC would probably have a relook. But best wishes since they are having a NFO at this stage.
Absolutely. I also asked about the allocation. What's appropriate, Amol?
You mean to say the multi-cap funds within your portfolio?
No. For an investor choosing to invest in a multi-cap fund, what is the kind of, assuming that they have the risk appetite, of course, and you said that it's a good idea to combine it perhaps with a flexi cap fund, but what is the kind of allocation we're talking about?
I would say 30 to 40% into multi-cap funds, and I'm also, I have an opinion that you should not have like 10, 12 schemes. You should have a very kind of tightly managed portfolio at investor level of not more than 4 to 6 schemes. So I think a flexi cap, multi-cap combination together can be around 40-45% of the portfolio, maybe one satellite allocation towards small cap or international, and 1 or 2 large cap funds just to balance the portfolio out. So I would say about 30 to 40% into this category.
Okay, I was quite curious about the top performers over a 3-year period and even a 1-year period, and I must say that the performers are quite evenly matched between flexi cap and multi-cap. Do you have any schemes that you like in the multi-cap category, Amol, that you'd like to talk about?
Right. So if you look at, out from today, I would say within multi-cap category, you can look at probably ICICI Prudential multi-cap fund. That's something that it's a part of our portfolio. It follows a typical, what I mean is it follows the valuation-based value kind of orientation into the multi-cap. The size is not too big. So we like this scheme and it is part of our portfolios. Okay,
fantastic. All right. I think that more or less covers the topic of multi-caps. I did want to take queries, but unfortunately, because of the kind of conversation we've had, I didn't want to cut it short. We will take more queries tomorrow, though. Do stay tuned.
Sure.
Amol, I'd like to thank you on that note. Thank you so much for joining in. Always an insightful conversation with you.
Pleasure to be here. Thanks, Alex.
Viewers, it's been an absolute pleasure bringing you this program. Thanks so much for watching. We've got lots lined up over the course of the day, and this is NDTV Profit.